Coming up in today's show, stocks start the month higher, unemployment reaches an 18-month high, market getting excited that the Fed may be done, Bitcoin falls further, oil breaks out on Russian news, Tesla dives on price cuts, and the little-known indicator that just confirmed today, Max Pain is coming. Welcome back to the Click Capital Daily Market Show, everybody. My name's Jared. I'm going to run you through the most important news, data, and charts from the markets today to get you up to speed with exactly what's happening out there and where the opportunities may lie. So the first day of the month, September, got a bit of bullish breadth out there. Most sectors finishing in the green, especially energy on the back of that rise in oil, which I'll get into a bit later. We did see Tesla and NVDA come off a little bit and the financials put in a good performance. But the biggest news out today was non-farm payrolls, with some people calling it the near-perfect jobs report. But the headline number of job gains coming in higher than expected, 187,000 new jobs. That was versus 170,000 that we thought we were going to get. However, the big one that stuck out to me today was the unemployment rate, coming in a lot higher than expected, 3.8% versus consensus of 3.5%. And you might be wondering, how can non-farm payrolls come in higher than expected at the same time as the unemployment rate jumping a lot higher than expected? That's basically because there's more people coming back into the labor market looking for a job. We can see that in this chart here. That fell off sharply in COVID after government stimulus and no one wanted to work. However, that's been back on the climb and approaching pre-pandemic levels. And just looking at a 3-year chart here of non-farm payrolls, we can see that has been downtrending steadily. And on the same 3-year period, the labour participation rate has been climbing steadily. And with that unemployment rate coming in today at 3.8%, that's caused an indicator I've been following for a while now to flash a signal today. And for my regular daily viewers, you'll know I've been watching this one basically all year. And what we've got here in the blue line is the unemployment rate. So you can see that's currently at 3.8%. And what I've got here in the yellow line is a 20-month moving average. So this is a monthly chart here. And so the 20-month moving average unemployment is 3.61. The latest report today pushes us above that for the first time in this cycle. Also on this chart, I've got in the shaded areas here where the US went into recession. And in the orange line is the S&P 500. So basically what I've found going back in history, pretty much every time this has occurred, when the unemployment goes really low and then curls up above the 20-month moving average, a recession is just around the corner. And S&P 500, again, has a near perfect record of always bottoming after the recession has started. So this is the last time here in COVID where we got that brief, sharp recession. The unemployment was low, went above the 20-month moving average. We got the recession, and then the S&P bottomed out afterwards. And just going back in history, this pattern is pretty much played out every single time. We can see here in the GFC, the unemployment rate went above its moving average. A few months later, we got the recession, and then the S&P 500 bottomed out well into that recession in February 2009. And looking back again in the early 2000s, same pattern again. Unemployment rate goes above its moving average. We get the recession, S&P bottoms out after the recession. I can just scroll you back in time, we can see the same pattern has played out over and over again. And like the inverted bond yield curve, this is a very strong indicator that a recession is likely around the corner. So here we are today with the unemployment rate really low, curled back up above its MA. And we can see here in the S&P 500, looks close to be putting in a double top formation. And just taking you back down to the daily chart in the S&P 500, we just closed above 4,500 today. Now, just because this signal occurred doesn't mean the market's going to top out right here today. In fact, the market can still run higher going into a Fed pausing scenario, as the stock market can get excited that inflation is likely to be under control with a softer jobs market and the Fed likely to be done raising rates. Structurally, that makes stocks more attractive relative to bonds, and the cost of capital for businesses a lot cheaper to expand and grow. However, the Fed typically pauses their rate hiking cycle because they're starting to see weakness in the economy. And don't forget, rate hikes can often take 12 months or more before they fully play out through the economy. And we've just come off the back of the most aggressive, fastest rate hiking cycle in history by the Fed. So what they've already done could bring the pain well into next year, even if they're all said and done right now. So as always, we just have to follow the price action technical analysis. The stock market could still break out and go for a run here. As looking back in history, it's often well into when the Fed has paused and then starting to drop rates. That's when we see the fall in the stock market. And that's because the Fed's cutting rates because they see immediate problems right in front of them. And just looking at the 10-year, 2-year yield curve, we can see that starting to climb back up here today. And just looking at a long-term 3-month chart of the 10-year, 2-year yield curve, we can see this is the most deepest and longest it's been inverted for the last 40 years. And that too is a strong predictor of recessions, but it's typically when the yield curve goes from inverted back to uninverted that the recession is just around the corner. We can see that back in the GFC and the early 2000s. And you can see that in the price action of government bond yields today. up the front. The 1 year actually slipped a little bit. 2 year was only up a little bit, and the 10 year is up quite a bit more. And just looking at all the recession risk indicators, it's really only been truck shipments that's been holding up really well, and the anomaly. And up until recently, so is jobless claim. However, we're now starting to see signs that the labour market is starting to crack, get a bit softer, unemployment rate curling back up. And even though overall we've still got a tight labour market, everything's still okay for now. We've already got delinquencies on debt climbing in all categories: consumer loans, credit cards, and auto loans, as we can see in this chart here. After bottoming out in 2021, that has been steadily climbing, and they're all now at 10-year highs. So the chances that we get a recession in the first half of next year, I would say, are very high, probably greater than 80% in my opinion. And if you too agree that we're highly likely to get the recession sometime next year, then you might be thinking, what's a great way to position for that or potentially hedge that scenario? And one of those ways could be to hold US Treasuries, as currently year to date they're on their third consecutive year of decline, which is the first time they've ever done that. And that's on data going back to 1787, and that's after their worst yearly loss last year since 1788. And apart from buying treasuries directly, the best way to play that would be in the ETF IEF, which holds treasury bonds with 7 to 10 year duration. And we can see in the price action on this monthly chart here, it looks to be putting in a double bottom on a bit of a hammer formation. And that's after that steep decline we've had since March 2020, over 3 years ago. So if the Fed is done and they stop hiking rates and potentially cut rates next year, then this will bounce hard and provide a good hedge for what could be a really soft stock market next year. However, just looking at the VIX index here, falling to finish out the week just above the 13, the stock market is not worried at all for now. Conditions are quite calm. Everything is okay for now. And like I said, the stock market could easily continue rallying into next year. Could get a lot more excited with the Fed saying they're pausing. And if we get some of the biggest stocks in the market like NVDA and Apple breaking out to new all-time highs, that'll help things move along as well. And then we come into the bullish seasonal period around Christmas. However, like I said, the odds are that we are going to get a recession next year, and it would be almost a miracle for the stock market not to have a large correction at some point during that recession. Another way to hedge against the possible recession is by following our only bears strategy on the Collective 2 marketplace. And this is my own strategy that I personally look over. It always holds 20 positions short only. And with that recent pullback in the market, we're now back to outperforming the S&P 500, currently up 14.3% year to date. The strategy is up 19.7% since I started it in December last year. And I've recently just reduced the price for existing and new subscribers to $75 a month. And that gets you the real-time signals and alerts from all the trades I make in this portfolio. And you can pay a little bit extra to the Collective 2 platform to have it automatically traded in your Interactive Brokers account if you wish. And so my short-only strategy is already outperforming the market, and you can just imagine how well it'll do if we do get that recession next year. And for just a small allocation in your portfolio, it can make for a great hedge against the typical long-only portfolios that most out there have. If you're interested to learn more about this strategy, click the link in the description below this video, and you can come over to the Collective 2 platform on my strategy page and read more about the description of the strategy. And I suspect next year this strategy could potentially deliver huge gains to offset losses in the market. Another news out today, Bitcoin continues to fall lower. Finished August about 10% lower and hasn't been responding that well to the news we got from the court, which recently ruled Grayscale was treated unfairly by the SEC, which blocked it from turning their trust into an ETF, as they've been trying for years to be the first one to bring a Bitcoin ETF to the market. And just looking at the price action in Bitcoin, it seems to be finding support around this $25,000 level. And just taking you out to a weekly chart, it couldn't put in that higher high above the $30,000 level that we were looking for. And so just like the stock market, it's hard to call Bitcoin and crypto in a bull market or a bear market. It's kind of a sideways kangaroo market here. However, what is breaking out higher, and I'm getting more and more confidence in calling a bull market, is oil. Now, we've seen for the last couple of months, one of the largest producers in the world, Saudi Arabia, cutting their supplies, as their target price for oil is in the mid-80s per barrel. And we've also just got news out of Russia today saying they're going to announce further output cuts next week. And this is a bit of a change over the last couple of months earlier on the year when Russia and Saudi Arabia were at odds with each other. But Russia's deputy prime minister said now that they agreed with their partners from OPEC Plus that would bring further output cuts soon. And just looking at the price action we got in crude oil futures today, closing at $85.55 a barrel and breaking up above this key resistance zone I've been watching here for a while. And just taking you out to a weekly chart here, oil's now at the highest price in almost a year, and looks likely that we're going to put in a higher high and give us confidence technically that we are in an uptrend here. And before we know it, oil could be back above $90 a barrel, heading towards $100, and that's going to put significant upward pressure on inflation and likely pinch the consumer further. And who knows, that recession may come a lot faster and nastier than a lot are expecting. Because even though at the start of the year, things were looking like a recession may come this year, we did have that weaker crude oil price most of this year to help out with the cost of energy and everything else that oil goes into. And so the odds of a recession have just been pushed back further and not away, in my opinion. And that move higher in crudes helped the overall commodity index break out today as well on volume. And that was even in the face of a stronger dollar as well. So crude and commodities are pretty strong right now. And it looks like the oil producing nations are going to put the squeeze on to add further fuel to that. Another news out today, we got Tesla announcing massive discounts to their Model S and Model X in order so they can get the EV tax credits. They dropped the starting price of the Model X to $79,990, and that's a huge $41,000 reduction from the start of the year. And the Model S has come down from $105 at the start of the year, now down to $75 as well. And they did have room to do that as they have the largest operating profit margin in the industry of electric vehicles. However, the market didn't really like it and sold it off quite significantly, 5% today, and lost its 50-day again on volume. Also out today is the forgotten leader of the 90s, Dell, topping estimates in their earnings, beating on both the top and bottom lines with a huge surprise in EPS, 52% to the upside, and the market loved that today, finishing up 21% higher on huge volume. And that's a new all-time high ever since they came back onto the market in 2018. And just looking out to next week, markets are closed on Monday to observe Labor Day. We've got a little bit of economic data coming through Tuesday, Wednesday, with some PMIs, a few more earnings coming through, and as always, we'll be looking at the weekly jobless claims on Thursday. Other economic data we got out today was manufacturing PMIs, and they are still below 50 in contraction territory. It's only really services that's been holding up the economy and helping to keep inflation sticky as well. And that higher than expected unemployment rate has further added weight to the probabilities that the Fed has done. Now 93% chance they'll pause later on this month, 62% chance they'll keep it the same rate in November. And then the market is actually starting to price in little probabilities that we'll see a cut December, January, and March. And just following this blue boxes here, that's the trajectory the market thinks that the Fed funds rate is going to go. So the market's expecting next year the Fed funds rate to be 4.25%, a full percentage point lower than where we are now. And that's basically the bond market saying a recession is coming at some point next year. But for now, the stock market likes the fact that the Fed may be done. And we can see that in the fear and greed index moving back into the greed zone today at 56. A typical Friday in the options market coming in just above 39 million contracts traded, 54% of them calls. And a little bit of enthusiasm here from dark pool traders getting slightly back into the bullish zone here. And a slight uptick in the amount of corporate insiders buying their own stock as well. Okay, back into the charts. The Nasdaq was the only US index to finish down on the day, and that was from Tesla and NVDA. And actually, the smaller we go, the better performance we got today. Mid-caps finished up 1%, Russell up 1.2%, and microcaps up 1.4%, but they're still below their 50-day VWAPs. Canada's TSX had a good day, coming back up to highs. The UK FTSE still looks to be in a downtrend. Same with Germany's DAX. A little bit of a bump up in the China 50 index, and there's the Nikkei 225 and the Aussie 200. This put-call ratio is starting to come down again as more people are starting to buy calls, getting excited that this bounce in equities could soon turn into fresh highs for the year, and a bit of an improvement in short-term breadth, 60% of stocks above their 20-day average, and a little bit of a breakout in stocks making new highs today on NYSE 92 and 65 on the Nasdaq. And as has been the story for most of this year, mega cap tech is doing most of the heavy lifting. See that in the growth versus defensive sector spread coming back up to year-to-date highs. There's a look at growth stocks versus value stocks, and got a nice little bump up in small caps versus large caps today. Another indicator of global economic growth is the spread between copper, a growth commodity, and gold, a more defensive conservative commodity. And we can see that's been tracking sideways after being downtrending earlier in this year. And there's not much signs of trouble in the credit markets just yet. We can see that in the spread of high-yield bonds versus treasuries, and even in high-yield bonds versus investment grade corporate debt as well, still in uptrends. There's a look at TLT coming off a bit today as we got the move up higher and long dated treasuries. We've already gone over the dollar and Bitcoin and commodities. There's a look at gold just sitting flat at $19.66 an ounce, and uranium starting to go on a bit of a tear, finding new year-to-date prices today. And over to stock sectors, a bit mixed out there today. Found higher highs and higher lows. And the cannabis ETF MSOS that got up to 744 today. This thing is super volatile, so Wouldn't be surprised if we get a bit of a pullback down to $6 a unit next week. And there's semis kind of stalling out at their highs. Home builders having a good day, coming back up to their year-to-date highs, and got a little bit of a bounce in the regional banks. But those defensive sectors, healthcare, staples, and utilities, still really weak here. So not much of a defensive rotation going on in the stock market. There's ExxonMobil and Chevron breaking out in the back of that move in oil. And mega cap tech was a little soft today. NVDA was actually off by 1.7%. Still sitting around those all-time highs of $500 a share. And this will be a big one to watch next week. There's the $100 billion Vietnamese electric scooter maker, Finvast, falling another 15% today. I was away on vacation while this thing was rocketing. However, I wish I got a chance to short it, and I'm keeping it on my short watch list. If we do get a bounce and a bit of a retest, maybe up to $60 or $70 a share, I would love a chance to short it, as I think the valuation is ridiculous. So I'll be keeping an eye on this one for the next couple of weeks as well. Across the meme space, pretty mixed out there, and not too many other story stocks of mention. There was some good price action in the banks today, as they seem to like that economic data. And just looking at my S&P 500 oscillator, now sitting at 59.2, just below the overbought level of 60, and on a pretty big bearish divergence as well. If you're interested in learning more about my custom indicators for TradingView and how you can get them, then click the link below this video and you'll come to my website, clickcapital.io. You can watch a video on there where I go over in detail how to best use all 20 of my custom indicators for TradingView. And another indicator I'm watching is my dynamic swing index, the DSI, which is forming a pretty big bearish divergence as well on the S&P 500. Still seeing whether this bearish engulfing from July 27 can play out for a medium-term correction, and kind of similar setup on the Nasdaq as well. Sitting right at the bottom of this resistance zone, and just looking at a clean monthly chart of the S&P 500, we could be setting up a potential double top here, and same with the Nasdaq as well. However, it's still possible that the market gets excited when the Fed signals that they're done hiking rates and they're going to go on pause. They'll probably stay on pause for a while until they see real trouble out there. So we still could pop above 2021 highs and make new all-time highs, and that could potentially be a massive fake out and bull trap, because like I said, the odds are that we do get a recession next year. It would just be in the face of so many indicators if we didn't, and truly be a miracle escape. It's not to say that it's not possible, it's just not probable. And remember, corporate earnings are already in a recession, with the third consecutive quarter of year-over-year earnings decline. And a recession would likely just deepen that contraction even further. And remember, long-term, the stock market correlates with earnings per share more than anything else. So the last shoe to drop is the jobs market, and that's the data we'll be most focused on going forward on this channel, and probably with the Fed as well. Because now it looks like inflation may be under control. If the jobs market does keep getting softer, that's downward pressure on inflation, then the focus will be the jobs market that gets a lot weaker, then may really start to crack. We've got student loan repayments starting back up, consumer debt all-time highs with high interest rates, delinquency is already on the rise, and if the jobs market were to fall apart, that could all get really messy really quick. So we'll just have to see what happens until then. That's all I got for you this week. Thanks very much for sticking with Click Capital. Appreciate all your support, likes and comments. You're welcome to share your thoughts below this video. I respond to everybody. I hope you have a great long weekend, and I look forward to making a video for you guys come Tuesday afternoon. Cheers.